eventually, when it was time where I knew I had to go approach a bank and see if we could work out some kind of partnership, what you will be required to do, although I'm not a proponent of business plans, is typically any bank you approach, especially if you're a startup, they need to see a business plan. So most likely you're going to have to create one. That's just a part of the process. So we basically interviewed with a couple of banks, continued to get no's until M&T Bank said yes, and they gave us a $50,000 term loan and a $50,000 line of credit. Do you want to explain the difference between the two of those?
Yeah, sure. Yeah, and I don't think, just to clarify, you didn't take anything down on the term loan, right? You actually never used that money, did you?
I've never touched any of it.
Yeah, so two options, right? And I'm not a banker, but certainly we paid off. We have some great banking relationships, but term loan is generally fixed in nature, so you're going to borrow money over a period of time. Let's just say it's a 5-year period, and in that 5 years, like your home, not too dissimilar from your home, you're going to pay that money back at some type of an interest rate. Line of credit, a little bit different, and depending on where you are in what you're buying too, because a term loan is generally normally tied to a longer event and usually tied to what are called long-term assets. So if you're, and again, not to get crazy, and I think it would be great, let's get a guest on here to really get into this, because it would be great for our listeners who are thinking about starting businesses, who are going to sit across from a banker at some point, to know what's going through their head, what are the, what buttons do they need to push to be able to bring them on as a partner? Because your bank is just a partner. And they're a very cost-effective partner. That's something that's really important for people to know. Private equity, venture capital, all these different ways that you can get money. Banks, if you can create the relationship either through collateralization or through a very strong balance sheet, which is just a collateral component, as a great business partner, it's very inexpensive money. Coming out of the last 20 years, the least expensive money you could ever get. So just a couple of different line of credit is normally a little flexible, a little more short term. Think credit card. Now, not to that type of interest rate or that, but where you are generally borrowing money and you're just paying the interest on that money. So let's just say, I'll give you an example. We are in an aggressive growth mode and we need to buy inventory. So the line of credit is something that we might borrow money as we are putting cash into another asset called inventory, and it'll help with liquidity to bridge that gap until you sell that inventory, collect that money, retain your profitability, and then as you start to build your cash basis back up, you repay that money, get that interest expense back down. So just a couple of different options. And then as you become larger, the capital, the financial, the banking vehicles become much more significant, sweep accounts and all of those different things that you can start to leverage when you do to create some assets, liquid or otherwise, and you start to really value or pay attention to asset allocation, then you can get into that. But as a startup, that simple banking, who's willing to give me money to grow my business? Because it's about speed too. I mean, you could do it in a very organic way where you sell something and then you buy it from a supplier and your margin is your margin, and then you pay your bills and you have this left. And that could be a lot or it could be a little, but that's going to be a slower track than maybe if you borrow money or infuse capital to go buy more inventory to sell that inventory faster, and you bring on a partner, for example, in the form of a bank, where you would be using their money to invest in assets to help propel your business faster. So that's the banking conversation in a super nutshell. But
quite frankly, it scared me a little bit to take on debt, and I've been fortunate where we've been able to be in a position where we have been cash positive and had a lot of cash and been able to do everything we wanted to do, but certainly tapping that line can accelerate, as you say. I mean, why don't you talk about your experience with that and buying inventory or equipment or?
Well, the challenge with it too is it's variable. That's the biggest, the risk about that line of credit piece. Coming out of the last 20 years where interest rates generally were hanging around 3%, just call it that, whether it's prime or SOFR or LIBOR, whatever the different borrowing base mechanisms are. Very inexpensive means of capital. Well, in the last year and a half or 2 years, that 3 has become 8. So the challenge with that line of credit is it's a variable cost of funds. So it can move on you real time. And if you have not created the cash to be able to pay it back, right? If you haven't done something productive with that money or with that investment from the bank, then you sit there and watch your interest costs go up. It's not too unlike what's going on with our federal debt right now, for example, where, those interest numbers keep going up. Now, if you've done something smart with it, you've paid it back along the way, you have been conscious about holding the cash because it's still very inexpensive. You're like, why would I pay that 3% money back? I can go do something productive with this. And if you're in a position where if it starts to get a little rough or bumpy, you can just go pay that line down. That would be a great execution strategy. That's, to me, what right would look like, and that's what we've been able to do, is borrow to fund growth, but not get crazy on the credit card, not overspend, get the return on the investment. That's what it really comes down to. And then being able to have those cash reserves to give that money back when it starts to get overly expensive, like 4%, 5%, 6%, now pushing 8%. Actually, short-term rates are higher than long-term rates, which is called inverted. It's an inverted yield curve when you hear that term. Usually, short-term rates are lower than long-term rates, but that is actually flipped right now, which is rare. But that's where we are with all of this craziness with credit markets and all the money that's been pumped into the financial system and all the liquidity, whether it was payments that went out to people for the pandemic and to help people along the way. We're living in some of the repercussions of that now from a banking perspective.
And I don't want all of that financial jargon, I'll call it, to scare anyone either, because I do understand that now, and it becomes more important as you grow. And you're gonna have the money to pay for professionals to help you. Yep. When I was just starting, I didn't know what any of that meant, and I didn't understand the ins and outs of banking or insurance or bonding, nothing. But I still got it done. So sometimes you just have to work through it, and you are organically going to learn as you grow and you develop. Don't let it scare you to the point where you don't do anything.
Well, just go sell, right? I mean, when in doubt,
go sell.
Just go sell.
Just go sell.
If you've hit on something that you agree that you want to risk your life savings on, right? Or if you're going to venture out and you're going to break out of side hustle and into a full-time gig, then go head down on what it is you believe that is of value and that is in demand and possibly undersupplied, or you believe that you've created a differentiated mousetrap that's better than everybody else's. Just go sell it, but you better be prepared on the edges or after hours to do all the other stuff, because it doesn't do itself and it's got to get done.
Welcome to Ace Rodney Talks for the Superstars. Tonight, guest, the incredible